please welcome to the stage Paul Davis from SRM.
Wow, that was an interesting introduction. I feel like I should keep my ego in check though after that, but appreciate you guys coming back after lunch. We're going to have a great program the rest of the afternoon. Yes, my name's Paul Davis. I'm the Director of Market Intelligence for Strategic Resource Management. We're a consulting and advisory firm based out of Memphis that does all kinds of things. We do a lot of work with vendor negotiations. We deal in AI automation, but we're going to talk a little bit more about our crypto practice, which launched back in November. I know you guys don't really want to hear from me. You want to hear from our panelists today, so I'll introduce them and they'll come up. First, we have Cynthia Schroeder, who is the Senior Vice President of Digital Assets for Visions Federal Credit Union. And then my colleague, Larry Pruss, who's the Managing Director for the Digital Assets Advisory Practice at SRM. So come on up, we're gonna have a great conversation, and we will open the floor up for questions at the end, but hopefully we'll do such a great job that you guys will be challenged to come up with some better questions than the ones we're gonna talk about. So we're gonna go ahead and start. You know, obviously I just introduced you guys briefly, but so let's start instead of a typical introduction. Just talk a little bit about your experience with crypto and digital assets, how you kind of got exposed to that, and kind of where you are on your journey looking at things like blockchain and digital assets.
All right.
You want to start, Cynthia?
Certainly. So I've been in the credit union world for the last 46 years, and last year my role changed to SVP of Digital Assets to start building the awareness and the education around digital assets for our organization. So I've spent, I think I started in February of 2021, just learning all the different parts of digital assets. We actually started with crypto, soon changed to digital assets because all the underlying technologies are really what interest us the most. So we've been spending the last year looking at all the parts of it, the whole ecosystem, and analyzing all of it, educating our members and our employees at the same time, doing surveys, building external digital asset groups for our credit union industry so that we could help guide them, and also our internal digital asset advisory group so that we can make sure that we have the support from our executive team, our board, all the way down to all of our employees. So that's been about the last year. We rolled out the ability for our members to buy, hold, and sell Bitcoin at the end of January with NYDIG. We did a soft rollout. We have not marketed yet. Right when we rolled it out, Bitcoin was going this way. So we wanted to do a soft rollout. We've had around 1,000 of our members, of which we have 230,000, but 1,000 have bought Bitcoin, about 4,000 transactions. We've seen an average age of about 46 and an average transaction of about $190. So it's been slow. We are doing some incentives around it just to get our members at least to get used to it and see what it's all about. And then we're looking at 40 other initiatives within that ecosystems, including rewards, a wallet, smart contracts, NFTs, all of it. We're excited about the whole underlying technologies.
Awesome, great. Larry?
So I'd say I came for the price and stayed for the technology. I'm a traditional retail banker, got my start at MBNA, Bank of America. I did a bunch of banking up in Canada, and I was introduced to cryptocurrency fairly early from some friends of mine, and I dismissed it at the time, thought there's no way this thing is going to stick around, seemed a little scammy. And back about, I guess about the same time Cynthia started looking at it, I started getting interested in it again, mostly because PayPal had announced that they were going to allow buy, sell, and hold. And so for me, that was kind of an indication that this was beginning to go mainstream. Spent about 3 months with a number of other members from our teams trying to understand the space. Became very convinced that this was going to kind of uproot traditional financial services, not just the cryptocurrency portion of it, but digital assets and the underlying technology. We started doing a lot of education to banks and credit unions, Spent the better part of a year doing that, talking to a lot of conferences, most of them virtual last year. And then in November of last year, we started our digital asset practice after a number of our clients asked us to help get solutions into the market. And for us, it was really identifying the proper partners who were kind of crypto digital asset solution providers in the market and matching them with either kind of the processors, the digital online banking providers, in some cases the cores, to start making those integrations so that our clients, when they decided they wanted a particular solution, those solutions would be ready. We've had about 10 active engagements to date, probably have spoken to well over 100, maybe 200 financial institutions on this topic. I do about 2 of these presentations a week, usually 2 board presentations, and this is probably the most interest that we've ever seen in any topic as it relates to kind of retail banking in the last, at least my career.
Well, great. Well, let's jump into the topics today, which is going to be the vernacular. I think where we're going to structure this is we're going to start out with layering in just some of the basic terminology. We're going to start as if, there are people in here who are walking in from the vendor hall with no experience in crypto. We're going to start with just some basic terminology, and then we're going to layer in, as we have this conversation, a look at some of the current events, look at some ideas of how financial institutions are dealing in digital assets, as well as the underlying technology that drives that, and then hopefully open up the floor to questions here as well. So let's start, first of all, with the idea of digital assets. I mean, for example, Larry had been kind of overseeing our quote-unquote crypto advisory practice when we started in November, but the journey that we've been on realizing that it's really bigger than just crypto. I mean, crypto gets all the headlines, right, Larry? But let's talk a little bit more about what really is under the umbrella of digital assets.
Yeah, so, I mean, we're seeing everything go digital. I mean, the digitization of music, digitization of money, and we've been seeing that for years, right? I mean, we can send money via ACH and wires, obviously MasterCard and Visa. I mean, we're not really sending physical money, we're just transacting ones and zeros. So that digitization has been there for years. What cryptocurrency and then associated kind of digital or decentralized ledger technologies and blockchains have allowed is that transfer of assets to happen 24/7, 365, 7 days a week, across international borders with instant settlement. And that doesn't exist really today. I mean, we've got real-time payments, we've got FedNow coming in 2023, but that solution's already out there, and a number of banks are starting to build kind of consortiums to do interbank transfers or interbank transfers. We're seeing it in the trade finance industry. We've obviously, from a retail standpoint, seen some interest in buy, sell, and hold. We're seeing rewards become very interested, but the term digital assets is much broader. We've got certainly cryptocurrency that falls under that, and everyone's familiar with Bitcoin and a lot of the altcoins, including Ethereum, Dogecoin, Cardano, and others. There's probably 20,000 digital tokens out there. And then, obviously Bitcoin is kind of in a little bit of a separate category. Then we also have central bank digital currencies, which our own Fed has been working with MIT on a number of projects for a couple years now. Interestingly enough, Bank of Canada is also working with MIT, and about 90 countries around the world are looking at implementing central bank digital currencies. Then we have another category called stable coins, which made the news fairly recently with Terra Luna that collapsed. It was an algorithmic stable coin, which turned out wasn't that stable. And there's different types of stable coins as well. You may have heard of non-fungible tokens, which are kind of like digital titles to either real world or digital assets. And then we're seeing even digitization of deposits. So the digital assets is kind of a broad category. Again, cryptocurrency gets a large segment of kind of the media attention, but it is much broader and has real applications for making banking more efficient, more transparent, reducing barriers to entry, and lots of things.
And we've broken them down to try and help us because there is so much, and we've done broke them into 3 different categories. So we have the assets, that's where the crypto piece and some of those, and then we have the products and services, and then we have the technology utility piece, which is where the underlying, the blockchain and that comes into play. And that's helped us be able to create our roadmap for what we want to implement first.
And Cynthia, if I can add that technology piece, I mean, it's broader than just trading. We've got people who are using it for doing international remittances. It's starting to creep into the payments world. It's really quite broader than just buy, sell, and hold of digital assets. And the price is interesting. You know, it catches all the media attention, but it's really quite a bit more.
Yeah, because we are looking at payment tokens as an opportunity too within that asset piece to be able to, between credit unions, to be able to have 24/7 payment opportunities and eliminate the payment rails.
And let's back up too and talk broadly. Just again, assuming that we're all on a certain skill level right now, let's talk about distributed ledger technologies. Blockchain is a subset of that, correct? And just kind of walk us kind of through, as your perspective as a executive at a financial institution, how much knowledge do you feel like you need to command in order to do what you do? And then, you know, Larry, when you're talking to banks and credit unions, you know, how much in the weeds do people really need to get into as far as understanding the underlying technology for this?
Well, you have to understand it, and it changes. It seems like it changes often, so that's why I've spent the last year really trying to build my knowledge around blockchain and smart contracts. And what we're finding is the opportunities around operational efficiencies are huge with the blockchain and smart contracts and NFTs and all. And I think that's what's made us that we're excited about the most, is those opportunities to reduce costs and to improve processes for our members, our customers. That's what we've been spending a lot of time on. And it does require a lot of knowledge. You do need to have individuals on your staff that take the time to really build that knowledge.
And then the digital ledger technologies, we mentioned blockchain. You mentioned, what did you just mention?
Smart contracts.
Smart contracts, thank you. I would add to that digital identities as well. So you think about, you know, how much fraud is in traditional finance because there's so many different touch points. The idea of digitizing people's identities so that you're sending a token as opposed to, you know, actual information about those individuals can also reduce fraud. So it's quite broad.
That makes a lot of sense. And I will mention too, you know, as we're talking about a lot of these terms, if you Google SRM, the bottom line, you can access our blogs that we do internally at SRM. And we just did our colleague Patty Wubbles just did a really nice piece that kind of walks you through the idea of distributed ledger technologies and blockchain. So I would recommend, if you have a second, you know, to Google SRM, the bottom line. And there's also several pieces from Larry as well on these topics as well. So a good refresher as you guys are, you know, leaving the conference. Let's talk also about the idea of, obviously, we've had these various subsets of digital assets, right? Crypto, stablecoin. Larry, you did a great job alluding to the difference why Terra had such a highly publicized meltdown versus other forms of stablecoin. Do you guys want to just walk us through just some of the general differences of why Terra was different than other forms of stablecoin, for example?
Sure.
You want to go first?
Yeah. So Terra was I think it's explained best by saying they were pegged by an asset, but not backed by an asset, which I think is the big difference. And that really helped me understand it. So they had Luna, who was there to be that backing, and Luna had bought Bitcoin as the reserves, but they didn't buy enough, and the whole process that was supposed to work did not work. It all failed, and millions or billions of dollars. I've heard 50, 55, 85 billion, I'm not really sure what the number is, but was lost with that because it was a very risky stablecoin because it was not backed by the dollar. It wasn't backed by gold. It wasn't backed by silver, and that's what made it so risky.
Yeah, algorithmic stable coins are not really stable, and most of them, I think all of them probably have failed. It was an interesting exercise. But most of when we talk about stable coins, they are backed by something. So they're collateralized, they're asset backed. Those assets can be US dollars, could be treasuries, could be other fiat currencies, could be gold, oil, whatever. Then there's also, they could also be backed by other cryptocurrencies. And so when we talk about stable coins, there is on-chain collateralization and off-chain collateralization. On-chain, we're talking about blockchain, so you could have a stable coin that is collateralized by, say, Bitcoin. Now, again, how stable that is, hard to say. But off-chain collateralization, which is what most people think of when they think of stable coins, are usually backed by dollars. Now, there is some concerns about some stable coins, whether they're fully collateralized or not. Tether, USDT, was one that had gotten into a bit of a tussle with, I think, Department of Financial Services in New York, and or maybe it was the Department of Justice or something. Anyway, they settled basically for a fine because it turned out they weren't fully collateralized. Circle has done a very good job of being fully collateralized. Paxos as well. And by the way, none of this is any sort of investment advice, but where I think this is going is, if you think about digitalization of money, a central bank digital currency would be something that would be very interesting, and our government probably needs yesterday, because China has developed a digital yuan, and that's been in existence for a number of years. They started working on it about 14 years ago. We are quite far behind, and the Treasury and Fed have both said that it will be about 5 years before we're ready with a central bank digital currency. Central bank digital currencies are interesting, gives the government a lot of control, ability to kind of tax every transaction, but also gives a lot of insight into transactions. And so there is a privacy concern with that. There's also a concern that central bank digital currencies would compete with existing deposits. On the other hand, stable coins, which exist today, are kind of the private version of a central bank digital currency. And much like the way that MasterCard, Visa, we share, they see all of our transaction data, but they don't share it with the government unless subpoenaed. Stable coins could also provide that similar sort of function and provide some sort of secure, or some sort of, what's that word I'm looking for? Privacy, as opposed to a central bank digital currency. Plus, they're here today. Most of them are backed by US dollars. So I kind of believe that one or many of the stable coins that are already in existence, if we can ensure that they're fully collateralized, if they are held at financially insured institutions, if they can be audited on a regular basis, can form basically the de facto central bank digital currency. And in fact, I expect that we will see their usage within probably the next 12 months. In fact, a number of the larger processors, FIS included, have announced that by the fourth quarter of this year, first quarter of next year, they will start enabling stable coins as well as native cryptocurrencies to be utilized at point of sale with merchants. And that's got obvious implications for MasterCard Visa volume, and then obviously implications for interchange. So we are seeing the world of finance changing. There are new rails that are starting to compete. And again, cryptocurrencies are just one of these. It's another form of payment, and it's very efficient, fairly cost effective.
So the way I take it from our conversation so far, there are three things that I'm pulling out of this. Number one, the importance of doing your research, your due diligence, and getting as educated as possible before you make any kind of movement into the digital asset space, number one. Number two, there are going to be winners and losers in these various forms of digital assets. Yes, there are scores of crypto out there, but only a few are really going to, over time, really solidify their place in society. And then the third takeaway I get, and we'll talk a little bit about this when we talk about the executive order from earlier this year, is that regardless of the headlines that we're seeing, about Terra or about, fluctuation of prices, digital assets are becoming more an increasing part of the mainstream, and they're not going anywhere. There will be some shakeout. Obviously, I think there'll be some learning exercises along the way, but this is a mainstream event it's here to stay. Are those fair statements?
Yes.
Okay.
Yeah, in regards to that, we've seen legislation proposed from Cynthia Loomis and Kristen Gillibrand last week, right before Consensus 2020, which is a big crypto conference down in Dallas, Texas. And it was interesting because it addressed cryptocurrency in general. It had addressed some of the tax questions, It addressed being able to spend at point of sale and limiting, tax requirement reportings for anything under, say, like it was $200 or $500 from a spend standpoint. But most importantly, it addressed stable coins, and it very much followed the recommendations that we saw at the end of last year from the President's Working Group, which was given to Congress, that stable coins be fully collateralized, be auditable, and be held at financially insured institutions. We also saw recently come out from Department of Financial Services, that's the New York regulatory body, similar sort of guidance around stablecoin. And again, that was last week. Last week when the senators were talking, and in fact, House Representative Patrick McHenry was there as well, seemed to be that, one, there was kind of broad bipartisan agreement on this, and two, they thought that by the end of this year, which would be remarkable given that there is some agreement on this, that we actually might see legislation as it relates to stable coins. And if that's the case, I think we're going to see implementation of that really proliferate throughout financial services. Where stable coins really came from were the exchanges and was a way for people to kind of get out of volatile positions temporarily, but it really has moved into the realm of banks and credit unions using them for settlement functions, and is starting to move into the realm of actual retail transactions, certainly online and then ultimately offline, as people will be able to use those digital wallets that are loaded with stable coins or other cryptocurrencies to be able to spend at point of sale. The interesting thing about that is, most merchants wouldn't want to take your standard cryptocurrency because of the volatility, but a stable coin they might be very willing to take because they could pay their vendors, they could pay their employees, and at any time they could go back to a US dollar.
And Senator Toomey, Senator
please.
Toomey was also at that presentation, and he was adamant that stable coins, they were going to push to have stable coins approved by the end of the year.
And the interesting thing about this, too, I know also when the Fed was seeking comments about the central bank digital currency, as well as with this proposal, this bill, the reaction from the financial services industry on both of those. I mean, it's one of those issues where you see the various, banking and credit union lobbies generally in step on how they feel about a CBDC, as well as how they feel about this legislation.
Yeah, I think there was concern from the financial industry that it would compete with deposits, which it would, because they're talking about a retail bank digital currency. And then there was concerns from the public around privacy and, would this become kind of a honeypot for foreign actors, kind of dethroning the US dollar potentially. But yeah, it was interesting to see consistent feedback. Where we might see a central bank digital currency is at the wholesale level. That would ultimately probably look a lot like Fed now, but at the retail level, I suspect it's going to be stable coins or something along those lines.
And there was a couple working groups, NAFQ and CUNA on the credit union side, that worked to answer the questions for the Federal Reserve that came out about the central bank digital currency, and it was not agreement.
Right.
Or not in agreement. Yeah.
Well, let's talk about the executive order from the Biden administration and how that also is putting various agencies to work looking at this as well. I mean, do you guys see that leading to any kind of more resolution, more policy, more mainstreaming, if we can make that word work, for digital assets?
I think what I believe happened with that is that it heightened awareness, and digital assets became important, and a lot more organizations are jumping in because of that. That's my opinion.
Yeah, and I think that awareness started with Congress last year with the bipartisan infrastructure bill, where there was a little bit of language that was added by Treasury through its proxies in Congress around defining who's a crypto broker, and it was broad and probably wasn't the best kind of congressional language, but at any rate, it passed, and Congress got more calls around that little piece of legislation than they've gotten called on any other topic previously, including Obamacare. So one, it allowed Congress to know this was an important topic in the minds of their constituents, which probably makes sense because somewhere between 20 to 30% of people own digital assets. Now that number may have gone down a bit because it was a $3 trillion asset class. I think as of this morning, it's a little less than a $1 trillion asset class. But nevertheless, it got their attention. What the President's Working Group did was really solidified for the various federal agencies that they need to have a plan to kind of coordinate and address digital assets. So President's Working Group gave all of those federal agencies which included Department of Homeland Security, Treasury, FBI, I mean, just really every IRS, every institution, I think 180 days to come together with a plan. So we've seen, certainly on bank regulators, the OCC, the FDIC, start working on this. Consumer Bureau Protection, Financial Protection Agency is also one of those working on it. Obviously, some of the regulatory bodies or potential regulatory bodies for digital assets, the SEC and the Commodities Future Trading Commission, both of them have been working on this as well. So what we are going to get to see out of this President's Working Group is better coordination, better awareness. I think that's going to turn into legislation, whether it's this year and or going into next year. And once we get those guardrails, the digital asset solutions, in particular digital ledger technology, is going to work its way pretty big into financial institutions. And you'll see efficiencies. And those institutions that understand it early and adopt it are going to do well. Those that don't, probably not so much. And the analogy we often give is what happened with Uber and the taxi industry. The taxi industry was heavily regulated, certainly at the city level, sometimes state level, required taxi medallions, you had high barriers of entry, you had to have a fleet of taxis, dispatch center, a bunch of employees, and the taxi industry thought, we're never going to be disintermediated. Well, then came along Uber, and Uber started to compete with them. Why? Because they weren't a taxi industry, they were a software company, and all they did was connected people who had cars to drive with people who had riding needs. And you think about traditional finance services, at a simplistic level, what do we do as banks is we connect people who have borrowing needs with people who have ability to finance those, so people have money to lend. And could that be done through software and smart contracts and over the blockchain and intermediate financial institutions? Absolutely, and in fact, that's happening today with something called decentralized finance. Now, it's nascent, right? It's new, but it's picking up very fast adoption, and it really is something worth paying attention to, starting to pick some partnerships and understanding this space, because this is one of those areas of technology. I mean, we've dealt with the MB before and contactless and things like that, and said, hey, digitization is going to happen and this stuff is going to happen. It never pans out to happen as fast as we think. Crypto is one of those areas where I tell people, if you think it's years away, it's months away. If you think it's months away, it's weeks away. If you think it's weeks away, it's just days away. It literally moves that fast. I don't think people in this industry sleep at all. It's really insane.
Yeah.
Let's take some time before we open the floor up for questions to just talk about just general kind of use cases. For example, we'll start with you, Cynthia. You walked us a little bit through the way you've kind of put things into three buckets. But walk us from your perspective where you think it's going to be headed from the credit union's perspective. And then Larry, you have consultations with the banking and credit union side of things. Curious kind of when you're meeting with people, what kind of questions you're kind of getting, and where's the mindset, where are people's heads in terms of where they think they're going to take this going forward?
So we did roll out the buy, sell, hold, but we only did that because we've been tracking the outflows and inflows of monies going to crypto exchanges for the last 3 years, and in 2021 that started to increase tremendously. So we knew we had interest, so we wanted to be innovative and at least have that rolled out. It isn't to make money, because that's not what that's about, but we are finding that members that do buy crypto check that often. It's like 65% more than your normal checking of your mobile and your mobile app. So it gives us the opportunity to have increased engagement. So that's an option for us. So we're building on that. Rewards, again, we want to move into rewards only because we feel like that could help our members learn about the technology. Mm-hmm. So we are looking at card rewards, and we're looking at education rewards within the credit union for our members and for our employees. The wallet is a big piece, because everything we want to do around NFTs, everything, smart contract, all of it requires a wallet. Mm-hmm. So we're really digging into the wallet, and then lending and collateral lending around crypto. That's another area we're looking at. So we've got 43 initiatives that we've prioritized with a matrix, and then we've got our roadmap for 2022 and 2023.
Okay.
And that level of engagement that you get through kind of a trading app is really important because, again, clients will look at that a lot more often than just your kind of digital mobile banking app. But that aside, what a lot of our clients are using this as an acquisition tool to win back business that is currently going out to the crypto exchanges, brokerage firms, the neobanks, the fintechs that all offer crypto services. So our clients are seeing, on average, and this is prior to the price downturn, but $1 million, $1.5 million of net outflows per month per $1 billion in assets. So that can be pretty substantial for a large financial institution. And one was to stem that flow, but two was to engage with the people who are tending to flock towards those crypto solutions. And yes, there's a large number of people who are holding it or buying it from a speculative standpoint, but there are also others that are using it from a transactional standpoint. So they're using it for purchases, they're using it for international remittances, they're borrowing against it. And those folks tend to be younger, they tend to be the millennials, the Gen Zs, which traditional finance has often had a hard time connecting with. So we're saying, like, use this as an opportunity to catch their attention, bring them back into the fold by offering these services. Now, those are retail services, and Cynthia mentioned a number of those. There are services as it relates to corporate lending. So, the crypto industry is actually quite large and has liquidity needs. There are a number of banks. Silvergate Bank is a good example of it. Consumers Bank out of Reading is another good one. Signature Bank. There's a number of banks out there that actually are lending to the crypto industry for their liquidity needs, and those have done quite well. Silvergate Bank grew their asset base by $10 billion in less than 12 months, so it's a thing. We're seeing it in trade finance in terms of leveraging the blockchain. We're seeing it in trust and financial kind of investment solutions, so either providing yield or custodial services for large existing digital asset holders. And then also you think about how we qualify customers or clients today for loans. A lot of us aren't considering at all their digital assets, right? And say you can make the argument if they're worth something or not, but at the end of the day, they are valued at something. And if you had a client that had $100,000 of, let's say, Bitcoin, would you want to know that in making a lending decision? I'm not suggesting that that would be your only qualification, but certainly that gives you an additional view of kind of their financial health. And then finally, just understanding that these digital assets aren't much different than traditional assets. Like, we're familiar with hard currencies and some of the complexities of tracing hard currencies and money laundering and stuff like that. People are often scared about digital currencies. Well, actually, digital currencies are a lot easier to trace because they're on the blockchain, and most of these blockchains are public blockchains and can be traced with the helps of there's companies out there, CipherTrace, Chainalytics, Elliptical, they all do blockchain tracing. So, like, if I was to show up in a bank with $100,000 bag of cash, you're going to want to know where that came from. Well, you can do that same sort of trace, but even more efficiently on the blockchain, using the blockchain to do that. So, a little bit information about some of the use cases. These use cases are growing every day, and again, we're just seeing movement. It's kind of like you think about the music industry back in the days, for anyone that remembered 8-tracks or records, and then cassettes, and then CDs, and then Blu-rays, and then MP3. And now everything music-wise is digital, and it's added to the ability for us to access our music, to send it to friends. It's made it more cost-effective. Well, we're seeing the same thing with money. So don't dismiss it. It's not going away. Those that are paying attention to this are going to be leaders in this space. I tell my clients that, in 5 years, the financial institutions that really are going to survive longer term, and 5 years may not be the gate point to when they fail or succeed, but we're going to start to see those indications at that 5-year point are going to look more like software companies than traditional financial institutions, because they're going to be leveraging these new technologies, the digitization, the blockchains, the distributed ledger technologies to be efficient, and if you don't, there's not going to be a way to compete.
Well, I appreciate that. We've got about 5 minutes left. I'd love to open the floor up for questions. I'm sure we've given you guys a lot to think about, so. Dan's got a question.
Yeah, I got a good one. So yesterday, the real-time payments panel was up there, and someone asked a question about CBDC, and the immediate response was, terrible idea. Do you guys, I was trying to discern whether you agree with that or not, and then I'm actually kind of a follow-up to that. Are the real-time payments team side in a little tug of war with digital currency or a centralized digital currency?
So it's a little different. So I would agree that I'm not a fan of central bank digital currencies, certainly at the retail level. I think they've got a place at the wholesale level. At the retail level, I'm concerned that they make banks irrelevant. Yep. And plus, the Fed's just not that good from a technology standpoint. You know, they're not move fast and break things, and we don't want the Fed to move fast and break things. We want whatever they roll out to work. That wholesale version, again, could be like the Fed now. Real-time payments does, to some degree, compete with cryptocurrencies because it's 24/7, 365, it's real-time settlement, it's a lot cheaper than we've seen traditional payment mechanism. I don't know what it is, but I think I heard like it's only a couple cents per transaction, which is kind of similar to many cryptocurrencies. The difference being is the real-time payments is US-centric, whereas cryptocurrency is worldwide. So, which does pose a problem for capital controls for countries, but there's a real benefit for industries or individuals. Like, you know, I could send $10,000 to El Salvador like that, and I don't have to, you know, you couldn't do that with real-time payments. You couldn't do that with Fed. Now, I mean, you're going to have to do it through the SWIFT system, and it's going to be a hassle, and it's going to take a while, or I'm going to have to send money through Western Union. Like, the ways to move money internationally today is not really smooth. And we live in an international world where commerce is international. So why shouldn't we have currencies that can act and flow with that same ease that we can send emails to each other? It's a good question.
We did have a call with the Federal Reserve, and we talked through the central bank digital currency with them. CUNA, which is the Credit Union National Association, organized that call with quite a few large credit unions. So we could hear firsthand from them why. What was the why behind it? And their message is good, and they have some good reasons. But losing control of that, we feel it should stay within the private sector.
And one of the reasons the Fed is so interested in this is that, you know, the US dollar has been a reserve currency of the world for a long time, but you know, it's consistently dropped in terms of number of central banks that are holding it as that reserve asset. I think it's like 60% of the reserves in central banks today are US dollars or treasuries, something near equivalent. But they're super concerned about that, and they're super concerned because China has really been putting a lot of pressure, and then, you know, 90 other central banks, including the ECB, are looking at central bank digital currencies. So the US would like to come out with a solution. Again, I think stable coins solves that solution for them, but you know, I'm not the Fed, so we'll see where it goes. But no doubt something is going to happen, and it is going to change the way that we bank and the way that we transact. I think the biggest, I wouldn't say losers out of it because you know, they're going to pivot as well, but my biggest concerns are the traditional payment networks, the MasterCard and the Visas, American Express, Discover, Western Union, MoneyGram. Those that have been around for 40, 50 years collecting economic rents on those are now up against companies, decentralized companies, people who are driven by ideology instead of money, in new technologies that are faster, cheaper, more efficient, and I don't know how you compete in that environment.
Great. Good question. Terrific. Anybody else? Well, I appreciate, Larry, Cynthia, appreciate your time today. You guys feel free to pick their brains afterwards, and again, appreciate you guys sitting in on our session.
Thank you for your time.
Thank you.